First National Bank of Botswana has demonstrated a robust financial performance for the full-year period ended 30 June 2025, solidifying its position as a key player in the country's banking sector, having been in existence for 30-plus years. The audited financial statements reveal a period of sustained profitability, strategic growth, and disciplined risk management, all contributing to a healthy financial position. Good evening and welcome to this week's installment of First Issues, where we will be unpacking the First National Bank of Botswana's full-year financial results. The bank announced a profit before tax of 1.9 billion pula, a return on equity of 33.2%, and a dividend per share of 33 thebe. Before it was the largest commercial bank in the country about 35 years ago, First National Bank was a financial institution that had about 5 branches the country over, with only 2 in the capital. In its endeavor to grow, First National Bank of Botswana bought Bank in 1992. In 1994, Fnbb Botswana took over and bought Bank of Credit and Commerce International after difficulties befell them, leading to judicial management by Bank of Botswana, who then allowed Fnbb to acquire the bank. It's been over 30 years. The bank has since grown in leaps and bounds, operating through 25 branches, 172 ATMs, and 84 automated deposit teller machines. They introduced e-wallet services with net transaction volumes of 15 million, Cash Pass services that facilitated over 8.4 million transactions from 1,794 agents across Botswana. The team of about 1,700 is currently led by Chief Executive Officer Steven Bogatsu and former Chief Financial Officer, now Deputy Chief Executive Officer Dr. Mbako Mbo, who at the reins of Strategy 2025, which has over the years ensured that the bank successfully navigates shifts in customer behavior, demonstrating the bank's responsiveness and agility to market trends. Our conversation is first with CEO Steven Bogatsu, starting with key achievements they have realized with these results.
You will remember that 2025 was actually the end of our strategy 2025. So this financial year that we are looking at was actually the end of our 5-year strategy that started in 2020-2021. A number of challenges that the economy was going through during this period. We have had to pivot the strategy and adopt certain tactics in order to help us navigate the challenges that are besieging the economy now. From a balance sheet perspective, we had to curtail growth. The strategies that started in 2020 was around digitization, driving customers to our digital platforms. And we have seen that coming to bear in 2025 with a good growth in NIR, which to a very large extent compensated for the loss or for the muted growth that we saw in NII.
In our previous conversation last year, again, 2024, for the same 4-year period, we had brought it to your attention that some of your clients were actually having this perception that the bank's charges are unfair, for lack of a better word. What has been your response to that?
So a number of things. We decided to drop some of the charges that we previously had for both the retail customer as well as for the SME. What we also did was we decided that for the benefit of our customers, we were going to zero-rise some of the transactions, especially transactions around accessing the app, etc. And lastly, we have just embarked on an exercise of one, communicating our fee structure with our customers, and secondly, explaining the fee structure, communicating and explaining the fee structure with our customers, and just simplifying our charges.
That is quite the approach, and we hope that your clients are going to be pleased upon hearing of some of these interventions that have been put into place. But I want us to go back to your first answer, particularly on the point where you were talking about the strenuous environment within which the bank was operating. And I believe that the same has been the same for other corporates. We're seeing organizations encourage their staff to take voluntary exit packages. Such organizations like Botswana and the University of Botswana, all of this in effort to maximize resources. So my question really at this point is, how prepared is the bank to support some of their clients who may be affected by this turn of events?
Thank you for that. That's a very good question. So we have engaged a number of organizations, and we continue to engage a number of organizations that are going through such restructures. There are various solutions that can be applied that are on the table. Solutions such as giving discounts when our clients receive their packages. We can look at some of their facilities and agree which ones we can discount in order to enable them to settle using the exit packages that they are getting. For some, we are restructuring the facility to give them a bit of air to breathe. So there is within the credit department an area that we have now called Real Help. Allows customers to come in, present their case, and based on the case and the circumstance, they are able to apply various interventions that are available to customers.
bitsa motho gore motho a leke mangwala go duela metsi.
Mama, ka re male jana ha o tlhoka le go tsamela kgakala gore go duela metsi. Fnb re diretse tiro motho.
Senthe.
Ma kwa go marekisetsong a ile gore ana le tshwala Fnb Cash Plus. Se se tlhokanyela ke o mang wa gago mo tirisong le reference number e bon dinomoro tse diriswang go ruragatsa dituelo tsa gago.
Fnb what?
Fnb Cash Plus.
Madonna makante ke montso sampolele ka mananeo a Fnb ya Cash Plus.
La ha re le nna ke gone go utwang ka dona ebile ke ne ke sa dumele.
Deposit cash and coins, withdraw from e-wallet, make cardless cash withdrawals, buy prepaid airtime and electricity, pay bills such as water, electricity and many more.
FNB.
Dona. Nyawa yena ke ra sa thare. Mpare motiki. Na ke ra go motho hela mamarapedi go tola sekontere hela o bua go semosong wa go duela semosong manane wa Fnb Cash Plus.
FNB, how can we help you?
Welcome back to the program. We continue unpacking First National Bank of Botswana's financial results for the 4-year period ended 30 June 2025. Our focus now shifts to the balance sheet, where the bank's former Chief Financial Officer, now Deputy Chief Executive Officer, Dr. Mbako Mbo, starts with a brief overview of the results.
First of all, I think we need to appreciate the peculiarity of the environment within which we produce these results. So the 6% growth is quite soft, and from that perspective, we believe it can be understandable. So what really led to this 6%, first and foremost, is the fact that our costs grew, but at a slightly lower rate than income. So that always sort of helps the story. We've got two classes of income, obviously. We've got the interest income and the non-interest income. Growth in our interest income was predominantly in the first half, and there was actually some shrinkage in the second half because of the liquidity, primarily because of the liquidity situation that we have, and the credit stress that we see permeating across the market. So the two things happened in the second half. The first thing that happened was that cost of liquidity was skyrocketing. It remained quite high for the remainder of the second half, and the credit stress basically meant that we had to relook at our credit appetite and slow down a bit. We still continue to lend, but certainly the appetite is not the same as it would have been under normal circumstances. So there was from year on year, we remain sort of flattish with a -1% degrowth in our non-interest income. Impairments obviously were also elevated, compounding the story of elevated cost of funds. We have got our non-interest revenue, which really comes from our non-lending business, where we had a good run. We did explain this morning that across all lines, transaction volumes were significantly up. Offerings like e-wallet, transactions across our Cash Plus platforms, swiping platforms like merchant services business, everything there, Forex, all lines were up. So this really assisted quite a lot. Our non-interest revenue went up 12% as a result. So that sort of carried the day, and we landed our revenue growth at 5%, which we believe is quite decent given the circumstances. We, on the balance sheet side, obviously, I did mention the strain that we see in the market, growth that we see, the advances to customers went up 11%, but that growth really came predominantly in the first half. Things were quite muted into the second half to the end of the year, but all segments grew. Corporate business grew 23% in advances, followed by commercial at 19%. Retail also grew around about 5%. So all these segments were up year on year. The story is quite different for deposits. There is a liquidity squeeze, so deposits are very scarce and very expensive. So that reduction, there's a significant reduction in deposits, particularly customer deposits. That is really what influenced the overall balance sheet position, which degrew by 5%. So that's, in a nutshell, the picture of the performance from a financial perspective. Let me also be quick to point out that from capital adequacy perspective, we are quite comfortable. The business is well capitalized. All our liquidity matrices are in a good position, but I have to admit we are seeing the strain, particularly coming from the situation in the market.
We're speaking about squeezes, constraints and degrowth, right? And we've seen a decline or a reduction in the dividend per share, which has gone down 23% compared to the 2024 period. Perhaps you could, elaborate further again what led to this decision or this figure.
That reduction isn't something that should worry our investors, that I have to be upfront with. So in the prior year, we were quite bullish in declaring dividends. Obviously, there are quite a number of things that you look at when you declare dividends. You look at your capital adequacy, how well capitalized you are. You also look at your investment needs down the stream. When you are in a subsidiary situation, and then there are other investments that needs to happen. All those kind of things. Investment decisions. What I'm saying in short is that investments decisions do influence the level of dividend payout that you make. This year, it's a peculiar year. We obviously do lots of stress testing before we make dividend decisions. We have to make sure that we remain well capitalized just after paying dividends, but given what's going on in the market today, we have to take a longer term view, at least a mid-term view, that also influences the level of dividends that we declare today. We've got a dividend policy that sort sort of makes us operate in a range. We have not gone out of that range last year. We haven't gone out of that range this year. And really our resolve is to operate within that range. So the 15 Thebe dividend is the final dividend for the year, but it adds to an 18 Thebe dividend that we had declared at interim. So this is a 33% dividend, which we still believe contributes to a fair return on equity to our investors.
ta bitsa motho gore motho a leke mangwala go duela metsi.
Mama ka re male jana o tlhoka le go tsamela kgakala gore go duela metsi. FNB re diretse tiro motho
senthe
ma kwa go marekisetsong a ile gore ana le tshwala FNB Cash Plus. So se tlhokanyela ke o mang wa gago mo tirisong le reference number e bong dinomoro tse diriswang go ruragatsa dituelo tsa gago.
FNB what?
FNB Cash Plus.
Madonna makante ke mo ntse samplele ka mananeo a FNB ya Cash Plus.
La ha re le nna ke gone go utang ka dona ebile ke be ke sa dumele
ba bile ke heditse.
Deposit cash and coins, withdraw from e-wallet, make cardless cash withdrawals, buy prepaid airtime and electricity, pay bills such as water, electricity and many more.
FNB dona nyawa ena ke ra se thare mpare mo tiki na ke ra go motho ya la mamarapedi o tola skontere hela o bua go semosong wa go duela semosong manane wa FNB Cash Plus.
FNB, how can we help you?
Welcome back to First Issues. We conclude our discussion with both the CEO Steven Bogatsu and Deputy CEO Dr. Mbako Mbo, giving their take on the bank's outlook for the future. You did say that Strategy 2025 is coming to an end with this 4-year period, right? So what can customers now look forward to looking at innovative solutions, probably other products that may help better their experience with the bank?
Ever since we started this journey around digitalization and moving customers to electronic platforms, we still have customers who come in for certain products and services who come to the bank. So within the next 12 months, as I indicated from the 1st of July, we are eliminating all reasons for customers to come to the bank. So whether it's for loan applications, for account opening, for retail. For now, it's for retail. Whether it's KYC, we're empowering our customers to be able to avail of these services and products online, digitally through the app, without the need to ever come to a bank. So that should happen in the next 12 months. We are already at test phase with some of these products and services and expect many of them to be availed before the end of this calendar year, 31st December 2025.
What do you think, or what should clients look forward to in the next 4-year financial period?
There are two things. I think your question is two-pronged. There is customers, clients, what they should expect from us. And then there's the investor, what the investor should expect in terms of returns. I'll tackle the first one in terms of just what clients should expect from us. And I think we have this firm stand on shared prosperity. So our clients and our communities and our stakeholders should expect us to show up. They should expect us to continue our presence. And when I say presence, I mean across the country, be it in the most most rural areas through our Cash Plus agents, or in the towns through our branches, or everywhere else in the world or anywhere else in the world through our digital platforms, we will continue to be quite present. We are working on quite a number of enhancements in terms of just the solutions that we give clients, cutting across from the way we interact with them, what we offer them, how we offer to them, and what it costs them, the efficiency and the cost efficiency of banking. These are all things that they should gradually expect to see things just getting better for the client. To borrowing clients, we are not closed for business, and we don't intend to close for business. But the credit environment within which we are operating means that we will do things a little bit different. What I can tell you for sure is that when you see prime rate going up, it's not always reflective of the full reality in the market. We sit down when we do these things, we think of the client, and then we balance the need to cover full cost of funding with what really can the client afford, because remember, some of these affect pre-existing facilities, so we balance all these things. So clients should continue to expect that bank that think client in whatever we do. In terms of returns, as a bank, we value the consistency and sustainability of our earnings. So as much as we are operating in a distress, we just reported a profit of 1.9 billion. We are not going to be promising astronomical growth in the next year because of what we have, because of the circumstances in which we operate today. But we do promise our investors that we continue to run this business with consistency in mind, with the need to be a responsible bank in mind, and with investor goals in mind as well. I think that's basically what I can say.
In conclusion, the financial year for First National Bank of Botswana was characterized by a combination of strategic execution and a commitment to sound financial principles, leading to the bank's ability to generate sustained profits and grow its balance sheet amidst evolving market dynamics. And with that, we've come to the end of the program. Until we see you again next time, good night.